Hi there. Thanks for tuning in. Today, we're going to be doing an analysis and valuation of Kenvue, and this is a little bit different of a video because Kenvue was just in the news because of one of its products and how that has apparently come in the limelight of the US government. So stay tuned. We're going to break down the news. We're going to break down if this represents an opportunity for you or not, and also valuation metrics, getting a little more quantitative with it. So, first of all, what is Kenvue? Well, they are actually a company that spun off of Johnson& and Johnson about 2 years ago or so, maybe a little more, and they have a portfolio of these brands: Aveeno, Band-Aid, Johnson's, Listerine, Neutrogena, and Tylenol. So they have a lot of brands that you would buy at a pharmacy for personal care, really. The Tylenol would trick you into thinking that it's a pharma company, but not really, because Tylenol is a very, or acetaminophen rather, is a very known substance. They're not really developing more stuff like that in the pipeline. And all their other brands are more so personal care stuff, consumer staple stuff, right? So that's what they are. But the reason it's being talked about right now is because of this. Google Tylenol, and you're looking at apparently studies from the US government, or well, not studies, but just a link that has been drawn between autism and Tylenol use in pregnancy, apparently. So that's very interesting, especially because I don't know if there's actual evidence. If anything, there's evidence to the contrary. That would be that this doesn't really affect the conditions needed to develop autism, whatever those are. So this has sent the stock down about 10%. It's already been down 18.55% this past year, but now the stock went way down on February 5th or September 5th, sorry. And yeah, I mean, does this represent an opportunity? Is basically the question I want to answer. And looking at the stock, it still has a high PE ratio. It has a dividend yield of 4.5%, which looks not too shabby. But is this deceiving or not? And just like its parent company, Johnson& and Johnson, it's kind of a boring company in the sense that it doesn't oscillate that much except now. And it just has a dividend that just steadily grows and they pay out. But yeah, let's talk a little bit about the quantitative side of it to see if it's worth investing on the quantitative side. So if you look at this, they're a very slow grower, really. Single digits growth, sometimes down a little bit. They barely grew last year, and this year, their outlook is that they're going to shrink by the low single digits. And the profit margins, pretty consistent there. The operating margins also consistent, although they are forecasting a little bit of a crunch in those margins, just going a little bit lower. Return on invested capital lowering a bit. We don't like to see that. But yeah, I mean, there's not that much history because it was that spin-off from the parent company. But it's important to know that this is a slower grower with a higher dividend. That's kind of what they're gunning for here. Same as Johnson& Johnson's pedigree of a dividend aristocrat, where it's not really going to be that company that grows 50% per year, but it is something that you may be happy to own if you're a retiree. I don't think they're going anywhere. I put basically my calculations into a discounted cash flow model where the amount of revenue that they're turning into cash is going to be about 7%, which is in line with what they're currently doing. This is just a conservative assumption, assuming they don't better it in these next couple of years. The revenue is going to be a bit down from 2024. So obviously the cash flow is a bit down, and then just a gradual recovery from there. Now, the question here is after a perpetual growth of 3%, so they're going to grow by 3% forever, and my required rate of return being 11%, what is their fair value? And if you divide it by the total number of shares out, and then subtract the net debt, which they have a whole lot of, $7.6 billion, which is something that happens in spin-offs often. You spin off a company and also give it some of the debt. So it's smart to do of Johnson& Johnson, not so great for Kenvue. Well, you get a fair value of $2.63 with net debt included. But let's say we don't care about the debt. How much is that? Well, it's about $6.63, which is way off the target here of $18.62. Now, granted, that could just be because I am doing a very conservative calculation. But if you did want to know with this calculation roughly how much your return would be, then look at this here. It would be 5.5% instead of the 11% that I usually have. Now, 5.5% in kind of growth appreciation Paired with dividends, that could be a decent return. It could be about 9% or so, maybe. But yeah, the fair value here would be somewhere between what it currently is. So this would be more realistic to expect that 5.5% growth in the value of the stock. Is that great? I don't know. It depends on you. If you're a retiree, you probably don't care. If you're young, you may want to look in other pastures. But just to do a sanity check on myself, I was looking at Kenvue in terms of the EV to EBITDA, where the trailing is 13.4, the forward is 17.4. Comparing it a little bit, you can do this in valueinvesting.io compared to the sector, where there's other personal care and beauty brands here. And most of them have a little smaller EV to EBITDA or comparable levels, even considering that the industry median is about where Kenvue is and lower than where the forward EV to EBITDA is. Well, I'm not really sure that it is undervalued by any metric necessarily. If anything, it could be fairly valued if you like this method of valuation more than the discounted free cash flow, which you could say has downsides, right? If the debt is well managed, then it's actually undervaluing it. Or if they maybe have better growth prospects, then this could be a better valuation. But even then, it just doesn't convince me, And let's not even compare it to pharma, which generally has way lower EV to EBITDA. So my point earlier was that there's not really a link between these two things. If you read this study, the association between parental psychiatric disorders and risk of offspring, autism spectrum disorder, a Swedish and Finnish population based cohort study, all of these authors, credit to them. It's a longitudinal study tracking basically couples over 25 years and throughout Sweden and Finland and found pretty much no link between acetaminophen use during pregnancy and the chances of your offspring coming out with autism. So, the evidence points to the contrary, which does mean that downturn in the stock price is probably an investment overreaction. And you may have sort of different medical associations pronouncing themselves against this sort of link that has been established by the US government. But that changes sort of the nature of this investment, right? So what kind of play is this? It's definitely not a value investment, unless you're willing to settle for a lower rate of return, of course. Although a boring 5% return paired with a 4% dividend isn't too shabby, assuming the loss of market share isn't worse than expected. This is a model, and I think investors are looking at this company with uh, low to no growth in the next year or two, and then sort of speeding up. If it's worse, because if you see all of these brands such as Band-Aid, Neutrogena, etc., kind of have replacements. I can go and buy a generic Band-Aid brand, even though we know it's as Band-Aid. Same with Tylenol slash acetaminophen. I can just go buy a generic one for slightly cheaper. And why wouldn't I? So yeah, they could have a loss of market share, honestly, where this could be more of a legacy business that's slow growing and most of their growth is international. But if it's worse than expected, you could invest in it and even see a further downturn in the price. However, it could be a short term swing trade depending on the pushback to this new health and human services position. So this combined makes it a much higher risk trade. And realistically, how much could the stock even recover to? It's at $18 roughly right now. Could it recover to 22, something like that? So that would be what, like an 22% return? Well, that's not bad, but is it something you would be satisfied with? Are there other opportunities that could be better in that time? Maybe you just don't go into this trade if you can't sleep well at night knowing that you're invested in this company in particular, knowing that there's extra volatility. And I think that matters more. The ability of you to invest in something, knowing that you have conviction in it and knowing that you can manage the risk no matter how high or low it is. So, in general, just understand what drives returns in a company such as this, investing tomorrow in this would drive your returns would sort of be the pushback to this new news that has come out and the cycle here. So it would make it a shorter term thing rather than a longer term, perhaps. And you don't want to be caught holding the bag on this, but that would be what would drive your returns. And depending on your conviction of that pushback and of that not denting sales, well, you could go into this or just sit it out and wait for a different opportunity. But if you want something quantitative, right? If you want the amount of cash that a company is generating to be what drives returns, then maybe this isn't the best opportunity and you should look elsewhere. Now, thank you so much for watching. This was a different kind of analysis that I had a lot of fun doing. So if you want to see more like this, please let me know. Please subscribe if you enjoyed this video. It helps me a lot with the algorithm. And yeah, just drop a like, and thank you for watching, and have a great rest of your day.